Good afternoon, everyone, and welcome to TBR's webcast, Technology Force Transition, How Cloud and its Tech Cousins Are Catalyzing Change in Management Consulting, outlining performance, leaders and laggards, and future trends as reported in our Management Consulting Benchmark. I'm Allison Crawford, Senior Marketing Manager here at TBR, and I'll be your host for today's webinar. The management consulting industry is expanding into new emerging markets, with Deloitte and IBM taking the lead in the expansion. We'll cover how the market is changing due to these competitors and the increasing global perspective. But before I pass this over to Patrick and the rest of the Management Consulting Research team, there are a few logistics I'd like to cover. First, we're recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit this channel to watch this presentation or any of the others that we've posted. Second, we'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q&A or chat function. We'll address them at the end of the presentation, or you can request an inquiry call if you have additional questions. Third, we'll send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. You can also find the slides as well as other thought leadership pieces, webinar decks, and commentaries on SlideShare at www.slideshare.net/TBR_market_insight. And if you didn't get these social media links, I'll share them with you at the end of the presentation. Now let me introduce Patrick Heffernan, Brian Belanger, Stephanie Artigliere, and Boz Herstov. Patrick is a State Department and Deloitte alumni and is the lead on our Management Consulting Benchmark. Brian, Stephanie, and Boz are research analysts focusing on the vendors reported on in the benchmark. And with that, let me hand this over to Patrick.
Great, thanks. What we're going to do today is walk through the findings that we have from 2012 data in management consulting, and I'm going to explain why looking at 2012 is going to matter in 2013. We're almost all the way into August. But what I hope you walk away with after today is two things. One, an understanding of management consulting, the sort of the narrative arc, the story that goes from when we started this benchmark in 2010 all the way up to what we're seeing now in 2013 and going into 2014. Because this is a benchmark, it's a snapshot in time, but it really is the culmination of a lot of effort that's gone on over a few years. It's a story. It's built on a lot of data and a lot of different trends that we're seeing emerge. So that's the first part. The second part, I hope you have a ton of questions at the end, not necessarily for us based on what you've seen in here, but more questions about how what we've said is going to have an impact on your business. I think you'll see a lot of these trends, a lot of the key data that we point to is going to be potentially disruptive for your firm, potentially disruptive for what's going on in the marketplace. So hopefully you walk away thinking, okay, now that I know that, I need to know what's going to happen next and what the impact is on my own company. So we'll start with, you'll see here the things we're going to cover, some key trends and some key metrics. We're going to go off on three different tangents, one on Deloitte, one on global spread and localization, and that's not actually those are actually the same thing, although they don't sound like it. And then we'll look at IBM as well, and then we'll talk about what we're going to do in 2013. So before we get into the key metrics, the first thing that we're going to look at is what this benchmark is that we're talking about. So this presentation is based on a benchmark that covers 16 different firms, and if you look all the way to the right, you can see what I was talking about before. It's data that goes all the way back to 2010. And then just to look for a second where it says key metrics, this benchmark includes a vast amount of data. It's got Excel pivot table, it's got everything you could possibly want to know about these 16 companies, based on all the breakdowns you can see there by service line, by region, by vertical, and over that particular time period with all these metrics in there as well. So I think it's important to know that the benchmark isn't just sort of a look at the management consulting marketplace. It's instead a look at 16 vendors going very deep on their management consulting practices and building up to an understanding of what's happening in the marketplace based on those 16. So that's sort of the framework of how the benchmark works. So what are the key takeaways from what we saw in 2012 and how we understand the impact on 2013? The three big things are emerging technologies, what we're calling boots on the ground, and then changes that are coming in the vertical spaces. So emerging technologies, this is cloud, digital, analytics, and mobility. You can throw social in there as well if you'd like. But the emerging technologies, the real story here, and we're going to go into this in a little bit deeper in a few minutes. The real story here is that rather than necessarily a convergence of technology with management consulting, we're talking about emerging technologies permeating throughout the different management consulting offerings. It's becoming essential to come to the table with a cloud solution, with a cloud offering. It's becoming essential to have analytics baked into your management consulting offering. That's a change, and I don't want to go too far into this before we get into the details, but we basically look at 2012. From what we see in the data is the year that lots of management consultancies, and these 16 vendors in particular, acquired or built the capacity to do these emerging technologies. 2013 is the year that they're absorbing, rolling out, sort of making sense out of these offerings, but totally bringing them fully into their suite of services. And then 2014 is where they really take off. The second key takeaway, boots on the ground, we're going to go a lot deeper into that in a few minutes, but what that means is a change in the operating model. Rather than parachuting a team in for a few weeks for an engagement, you're actually recruiting and retaining talent locally or sub-regionally to handle both the local market and the international market that's trying to play there. And then lastly, the verticals is interesting because financial services is still huge, and it's probably always going to be the largest of the management consulting verticals. And healthcare has been growing for the last couple of years. Again, when you look at the benchmark as a story of 2010, 11, 12, and now into 13, you can see healthcare consistently going up, and pretty much for every single firm in the benchmark. What we look at, though, is we look at what we saw in 2012 and what we anticipate in 2013, and what we're seeing now is that energy, manufacturing, and retail are probably going to be the three fastest growing verticals, and we'll get into why that's the case in a few minutes. So now we need to look at the big key takeaway, the big bubble chart. This is the one that just yesterday had a conversation with one of our clients who praised us for presenting this particular graphic, this particular look at the marketplace through this particular bubble chart. And so here you have this is the big picture. These are all 16 vendors. This is headcount and revenue overall, 2012. And you can see on this, the big guys grew, the guys in the middle didn't grow so much, didn't go down so much, and then you have firms like Capgemini and Aon Hewitt and Oliver Wyman towards the bottom who are stagnating or starting to really fall off the back of this map. Why are the big four firms growing? We're going to take Deloitte as a case study in what they're doing so well, and Boz is going to go into detail on them. The important thing to know there, the two big things on this. The reason the big four firms are growing is because they've got that permission to play across the entire space of management consulting. They have the right people, and they are known to in the right offerings. In addition, they have their global member firms that have entree into companies, not necessarily through consulting, but through the other services they offer. So that's one of the reasons that helps them grow. Then take one giant step backwards and imagine this particular chart in, say, 2007 or 2006, PwC, KPMG, and EY aren't even on this chart. So you can see that not only are the big growing, but they're growing very, very rapidly. So if we take a look here to go into Deloitte, again, Boz is going to go much deeper on Deloitte in just a minute. But what I want to show about Deloitte that's important here when you put them in context of the others is what a huge percentage of the management consulting benchmark they make up. Now, it's important to note that is that number there, that they're 15% of the total revenue of the vendor that are covered in this benchmark, not the management consulting market as a whole. But clearly these are the top 16 companies in this area, so this is significant for them, and they're growing up, only going up 1%, but still, Deloitte is big and getting bigger. IBM and Accenture, in contrast, have sort of spent 2012 treading water a little bit. Brian's going to go into depth on IBM. Accenture is interesting in that it's still growing, not quite as fast. We think in looking at 2012 data and what we've seen at the beginning of 2013, these two things are going to change. We're going to see these two companies certainly not reaching the same revenue totals as Deloitte or some of its big four competitors, but certainly growing faster than they grew in 2012. And we'll get into the specifics on why we think that about IBM in a couple minutes, but What I'd like to do now is hand it over to Boz and have him talk specifically why Deloitte has been had such a successful 2012 and what we think about them in 2013. Boz?
Yes, thank you, Patrick. Hello, everyone. My name is Boz Christoph. So Patrick brought up the three key findings in the beginning of the presentation and tried to link those towards Deloitte's performance and what Deloitte does to highlight their outstanding performance and standing out of the crowd. He spoke about the shifting in the hiring model and talking about using technology and also emerging verticals. Deloitte is a well-known brand throughout not just management consulting, but also through tax and audit businesses, and that's what they actually leverage. They well-established network of firms across 150 countries to gain that local insight and to foster those client relationships, and so they can pinpoint locally relevant opportunities. Deloitte has been and continues to do a very good job attracting top talent, and they continue to do using technology as well as the brand name recognition. Recently, I mean, one of the features that they used in retaining talent and attracting and retaining talent is they have launched Deloitte University for grooming professionals who are going to be taught the Deloitte way, and they can spread them out across the globe and really execute those new opportunities the right way Deloitte wants them to do. Mention about technology is one of the, I think, what we have found here as a team and following Deloitte a little closer, technology has played a big role in Deloitte's performance over the last couple of years, and I don't believe it's going anywhere else because while the technology consulting part service line was the second fastest growing service lines with the Deloitte portfolio, I would expect that to become the fastest growing within the next 6 months to a year. What Deloitte has done is really they have shifted their portfolio towards IT consulting services and offering clients emerging disruptive technology. As most of you are aware, Deloitte had launched Deloitte Digital back in May 2012, and they have very successfully leveraging and executing the idea of Deloitte Digital. They acquired Ubermind, the digital technology acquisition, and they helped already integrate it. Later in 2012, they acquired IE Discovery, among the other digital acquisitions they have pursued. And last but not the least, focusing on emerging verticals, and that's kind of the shift they have been doing, is having that local access, using the technology, and knowing where and what's needed. Deloitte have pursued very strategic fit acquisitions, so that makes them a little more successful. Prime example is they have pursued not significant of a large-scale acquisitions. They acquired a small energy company in South Africa, Venme, in 2012. While just 24 employees, they have 24 more people than some of their competitors know more about the area, know more about the energy sector in South Africa. As you probably know, South Africa is rich on energy resources. Another prime example is they're in the process of closing an energy acquisition in Canada towards the end of the month this year. So acquisitions, strategic acquisitions, having that local access, and really successfully executing and using technology consulting and having those expertise is what has made Deloitte successful.
Excellent, and I'm gonna build right off of that and talk about acquisitions, because this is something that 2012 stands out for. And what I've got here on the slide shows you just the emerging technology acquisitions, and the story we see in 2012 is up there. The acquisitions are made in this particular area. They're being absorbed and they're being scaled in 2013, and then I'm getting ahead of myself, so I'm already thinking about 2014 when growth is just going to be astronomical based on these acquisitions. What's really key when you look at this slide and when you look at what's in the benchmark are the two companies I've circled at the bottom. For years, the story on the strategy houses, that's McKinsey, Booz & Company, Bain, and BCG, is that these firms don't make acquisitions. That if you go back and read the benchmark from 2010 or 2011, and if you read the profiles, it's going to say that. And that here we are in 2012, now into 2013, and we see two critical emerging technology acquisitions by companies that never made acquisitions. Now, this is important not in terms of necessarily scale. Those were small size acquisitions, but it's important for two reasons. One, it shows that this pressure to pull in emerging technologies and to develop them and to have them as part of your full set of offerings is impacting everyone. It's not simply Accenture, IBM, Deloitte, and the other big four that have to do this. It's everybody across the management consulting space, even those companies that typically provide services at the very top of the consulting pyramid. But then the other thing that's interesting about it is it's coming from these two particular companies that are, sort of the oldest of the old in terms of the strategy houses. So for them, they're making a change where they're bringing in people and they're bringing in talent that's different than the folks that brought in the past. And that forces an organizational change, an operational change. These companies are going to have to do things differently because they've made these acquisitions. So again, from a TBR perspective, where we're looking at the companies in great depth and then building up to the story of the marketplace, we're going to see these companies have to operate differently than they have in the past. And there'll be all kinds of impacts on their revenue, on their metrics, all the way across the board, the headcount and everything else. So I think it's an important thing to keep in mind. Not only were these acquisitions made in a emerging space, but they are really groundbreaking for a couple of these companies. So we'll shift now to the service lines, and this is one of the things when you look at the benchmark and we thought about how to present it, there are certain things where there's just no story, and I'll be honest here. There's not a lot of great change in 2012 when you look at management consulting from a service line perspective. Operations continues to be the largest. Technology continues to grow the fastest. But the other two, strategy and organization change, also increased and not significantly below the other two. So I think that there isn't a great story here. Of course, it's worth keeping an eye on. It's worth looking at the individual companies and how their service lines have grown or have not grown as fast in this period, but as a whole, as a benchmark whole, there's just not a really great story here. So now we'll go to the geographies, another way that we break this down. And this is a great little map. Stephanie is going to go into much more detail on what we're seeing here, but I wanted to put the broadest perspective on it. If you look at the management consulting model from 10 or 15 years ago, it was to fly people in to do these engagements and fly them out, to have talent that you recruited from, the very best places and with the best education and all that, and bring them up. And you think of that model as the way that these management consultancy practices have operated over the years. So 2012, we started seeing acquisitions and new offices pop up in Myanmar or Burma, Cameroon, Ethiopia, South Africa. These are not places where we would expect to see an established presence. And so what's changing is that rather than operating from a fly-in, fly-out model, it's a put the boots on the ground and establish permanent relationships. And so I'm not going to say any more. I'm going to hand it over to Stephanie to have her explain the rest.
Thank you, Patrick. Hi, my name is Stephanie Artigler. So today I'd like to focus on the continent of Africa, and then we'll move over to Myanmar to see where the firms have been investing. In Africa, we've seen the management consulting firms investing in local hires, new offices, and acquisitions to target key verticals including energy, financial services, healthcare, infrastructure, and retail. Both PwC and KPMG have pretty aggressive multi-year plans to add both employees and infrastructure. For instance, PwC plans to add 8,000 new employees in Africa by 2016, as well as invest in infrastructure. And then in 2H12, PwC reorganized its African member firms into 3 regional hubs, West, East, and South. Additionally, KPMG unveiled plans to invest $100 million in Africa over the next 5 years, recruit 8,000 partners, and almost double its current $600 million revenue. A key example of a recent office opening is McKinsey in Ethiopia, which the firm plans to target the region's evolving industrial services and agricultural sectors. Deloitte has, as Boz has mentioned, has recently acquired a South African-based firm, Venman, adding energy and natural resources. And within the past 12 months, E&Y also acquired several firms, 2 in South Africa and 1 in Cameroon. So these markets in Africa, we like to classify them as emerging markets, meaning that about 50% of the clients are regionally based, and the other 50% are international clients looking to invest in the region and expand their business there. Moving over to Myanmar, this is a different type of market. We refer to it as a frontier market, where about 90% of the clients are international clients. We've recently seen firms investing in this country as it has presented a lot of consulting opportunities as global firms look to move into the country to target particular verticals such as tourism, natural resources, and agriculture, and also take advantage of the low-cost labor relative to other countries in Asia. It's important to note that not all industries in Myanmar were previously invested in due to government restrictions. Key examples of management consulting firms in Myanmar include KPMG, which has already established presence in the country, and we believe the firm's retail vertical is benefiting from the fast-growing middle class in this economy. Recently, in November, PwC added an office in Myanmar to capture opportunities with international clients and local businesses seeking sustainable growth strategies and looking to enter new markets. So to build out local market presence in these economies, management consulting firms are really using their corporate-wide initiatives such as employee training and career development programs to attract and retain employees. For instance, in fiscal year 12, PwC enhanced its employee programs, adding a leadership development experience program and a global mobile learning platform. These investments by PwC help the firm really unify its global member firms under its brand name, standardizing the quality of services and helping to win clients. Additionally, Accenture also has employee training and development along with career counseling and opportunities for employee growth. They have a global capability network which consists of over 1,700 employees in 12 locations across Argentina, China, India, Poland, and Spain, which strengthens the firm's consulting force, allowing it to cater to clients' regional demands and deliver quicker and to scale.
Excellent, thanks. And I think the important story there is that that's where we're seeing the most dramatic change coming from when it comes to geographies, and it's going to have an impact not only on where companies are, but how they operate. Again, I think one of the important things to note is companies are hiring, retaining, training, doing all that talent work locally, and that's only really possible or has become more possible in recent years because of the spread of better education, the opportunity for companies to find the right kind of people locally or sub-regionally and do that kind of work. So that's the new trend, that's the growth, that's the dynamic part of it. But underlying all that is the data we have in the benchmark that shows what's revenue been like for each of the geographies. And when you read through every one of the vendor profiles for the benchmark, all 16 companies talk about APAC as a place for growth. So it becomes to the point where you think, well, if everybody's growing in APAC, then nobody can be growing there because there can't be that much growth available. But you look at the numbers from 2011 to 2012, and it is significant. It's by far the fastest growing region. but in context, it's much smaller than the other two. Every management consulting firm needs to have a presence in the Americas and needs to have a presence in EMEA, of course, as well. Now, I've got a note on the side there on the left that says, will there be an impact if China slows down on APAC overall? It's something we can discuss if folks have questions later, but it is something we're keeping an eye on for 2013, and is that, are we going to see a 14% or higher number this year, or is it going to start to slow down? And what would be the impact on the vendors in this profile if the economies there change? So then when you sort of drive down one more level, I love this slide because that graphic on the bottom right is a total mess, and I'll get to that. I think it's great that it's so messy. But what I want to show here is in the U.S., looking just at the U.S., those green revenue bars are the total of the benchmark vendors' U.S. revenue. So you can see it's been going up, not quite as fast in 2011 into 2012. It's going up, so is the U.S. economy. Not at nearly the same pace, and you can draw whatever conclusions you want about the importance of management consulting to companies as the economy begins to grow. But you can see that there's at least some level of parallel movement there. When you come down one and you look at, that's EMEA, so those green bars on the bottom are the total EMEA revenue for the 16 vendors in management consulting. And EMEA is Europe, the Middle East, and Africa. What gets interesting is that when you look at the growth, there's a little bit of growth in 2011 to 2012 for EMEA as a whole, but it's that Euro area line that drops from 1.5% in 2011 to below 0 to -6. They shrunk, and that's the Euro area economies shrunk from 2011 to 2012 as a whole. In contrast, all the other economies listed there, the UAE, Ethiopia, Cameroon, South Africa, all grew. So you can see there's a divergence within what we have traditionally called EMEA, what is used throughout the industry as a region. And it makes sense for a few different reasons to have that as a region, but as I've got in that discussion point to the left, do we need to break this up? Do we need to look at Europe separately from the Middle East and Africa? And I would argue that this very messy chart tells us that we do. What we don't know for certain is how many of these vendors are doing the same thing. How many of them are beginning to look at Europe as a regional group separate from the Middle East and Africa? And then as we begin to explore that, we've got 4 countries up there. I'm not entirely sure those are the 4 countries that are the most significant in terms of management consulting and where we're going to see it in 2013 and beyond. But that's a good look at the geos, and now we need to look at the verticals. And again, financial services is the largest. If you look at the executive summary from the benchmark, you'll see that called out very clearly. Here I've got healthcare and manufacturing. Healthcare, everybody, again, just like APAC, everybody is focused on using healthcare for growth. And again, it makes you think, well, if everyone is trying to grow there, is it going to squeeze everybody to less growth than they could have? But there are some significant growth from 2011 to 2012 in the healthcare space. You look at Bain right there with 17.8 and Aon Hewitt with over 20% growth. But then you have to keep it in perspective of looking at the size of these firms. So everybody is growing. There was not a single vendor in this benchmark who did not have revenue growth in the healthcare vertical from 2011 to 2012. I think that will be true in 2013. I think we'll continue to see that kind of growth. But even if we see astronomical 20+% growth from some of these vendors, they're not going to get to the size of the bigger companies like Deloitte. Stepping down to the second chart there, manufacturing. I'll get further into healthcare in a minute. Manufacturing is interesting because what we see there is that the emerging technologies we talked about at the beginning, cloud and analytics in particular, lend themselves very well to the manufacturing sector. So while you don't see the same kind of growth, and there's not even the same kind of total revenue coming out of manufacturing that you see in healthcare or in financial services, we think that 2012 was the beginning point, and 2013 will show us a lot more growth in this particular sector. I've got 3 companies up there. Deloitte's up there so you can see the comparison between them between their healthcare and their manufacturing verticals. The other three companies are there because they're the most interesting in the space. Booz & Company, which had significant growth, to say the least, of 10% in manufacturing, and that not an area they had traditionally had a large presence. So they're growing rapidly there. Accenture and IBM dropped off. Brian's going to go into a bit on IBM. But what's curious there is both of those companies are positioning themselves in 2012 to have significant growth in manufacturing as a vertical in 2013. So we're going to see that. How dramatic that will be is up to those two companies and their clients, I suppose, but that's going to be the story for next year in that vertical. If we could take a quick look at healthcare as a vertical. Healthcare, what's interesting to me is when you look again back to 2011 in the benchmark then and now 2012 and 2013, those drivers are still there. They're still the same. They're not going away. So all that growth that we saw is being sustained by things that aren't changing that much as the healthcare sector as a whole has lots of factors that are uncertain or revolving or evolving. These are the same drivers that are moving demand in this area. And what's fascinating here, too, is I've circled the growth leaders at the top. It ranges from Deloitte and Ernst & Young in the Big Four to Aon Hewitt, traditionally a human capital firm, to Bain, and to Oliver Wyman. And so you have strategy houses, human capital firms, and the Big Four all doing extremely well in healthcare, and we don't see any reason why that's not going to be the same in 2013. The big factor that will have an impact, of course, is the emerging technologies and how those impact on this particular sector. So with all that, I'll wrap it up and hand it to Brian to give us the last tangent we're going to go down, which is IBM. Brian?
Sure, thanks, Patrick. And I'll try and keep it as a short tangent and wrap up. But I think IBM's worth mentioning for sure. And one is that it gets at what we've been talking a lot about with consulting and in previous presentations, which is this idea of an inflection point between management consulting and technology consulting. And I think it's sort of IBM, in the way it's structured, is a good model and a sample of how we see firms emerging in terms of a new management consulting model and also a firm to watch out for sure, in terms of performance. That said, in 2012, performance was a challenge for IBM. If we look at the graph here, we can see that it sat well behind Accenture in terms of growth. There's a number of drivers we see as really impacting that IBM growth number in the past year. Initially, it's just soft demand for consulting in mature markets. So not something unique to IBM, but definitely a driver, particularly in verticals such as financial services, where IBM generates a large chunk of revenue. A key factor was a lower volume of multi-year mega deals, and consulting is really key to those deals in that it's sort of the tip of the arrow that pulls through a larger solution, which we'll get into later, but a lower volume in terms of magnitude of those deals. Certainly some investment ahead of demand, which again we'll get into, but a focus by customers not necessarily on these technology-enabled transformation projects in the near term, and a misalignment, at least in the past year, as IBM invests ahead of where we see demand growing. And then just a tough year-to-year compare, and I'll also mention an internal focus as IBM really shifted to focusing on optimizing GBS, which is where its management consultancy sits, and realigning that business around these high-growth areas such as cloud and big data and analytics. So where we see the other half is in the 2013 outlook, and in how IBM has transformed where we think that puts the firm when we go out and do this presentation and do this benchmark next year. And so I was at an IBM Smarter Commerce event recently, and I was thinking about IBM, particularly in the context of consulting, and I asked the question in my head, first, why does IBM differentiate, and how does it differentiate from the Big Four that we talked about? And so after pulling that out of my head, I asked the same question to Peter Corsten, who's a partner in GBS and came over from PwC and heads GBS research and works around the whole push towards digital front office transformation. And his answer was very simple. It was integration, meaning IBM's not only a consultancy. It has an end-to-end delivery model. It can pull through analytics technology and software and cloud capabilities. And so industry and outcome enabled by consulting is really the front end, but that integration with those other organizational units is really a differentiator. And I think this is a place where IBM stands out from Accenture in terms of being able to lead with consulting and have that consulting footprint to drive an outcome, but be able to pull through those solutions as customers increasingly look for a vendor that can offer one throat to choke, so to speak, rather than offer high-level strategy advice, but have to partner with another SI to deliver. And just to quickly hit on this other graphic I have here, I won't go into detail on what this is showing, but it's a new initiative around IBM to jointly go to market with GBS, so it's consulting and integration teams, as well as SWG, its software group. So that in and of itself indicating plans to mobilize the go-to-market unit to aggressively bring both consulting capabilities to craft an outcome and make that align to industry-specific objectives, but pull through that software. And that end-to-end integration is a place where IBM stands out relative to the pure-play strategy firms, or the Big Four, and where we see really standing out as a growth driver. So with that, my tune's over. I'll swing that back to Patrick.
Thanks. And so, I think that's a good way to wrap up, because IBM and Accenture are certainly going to be companies, vendors that we expect a lot from in 2013. To go back to where I started at the beginning, this idea of emerging technologies permeating management consulting offerings across the board. Those two firms are well positioned to be able to roll that out efficiently, to be able to handle those kinds of transitions within their own companies. And so that's something that, and you see it at the very top on this current topics and what we're going to be looking at in 2013. We're going to need to understand how these vendors deal with emerging technologies as an offering, as something they have to change their own business in order to deliver to their clients. And that's going to shape how we look at the entire of 2013, but certainly the first half report, which will come out in just a few months. So these are the other topics. These are certainly not set in stone. We're as Brian mentioned, his conversations with folks in the marketplace, and all of us here at TBR have as many of those conversations as we can. We build the research based on a vast amount of data, but the analysis really depends on conversations we're having with folks in the marketplace and understand the challenges that they're facing both with their own clients and then with their competitors. You can see on the left some of the syndicated reports. The benchmark is what we've been presenting here today. Allison can walk through a list of some of the other reports that include these firms in them, cloud and global delivery, and Allison's giving me a look like she doesn't want to do that. But we've got a number of other reports that you can access, and Allison can explain those to you as well.
Sure can.
And so I just to wrap up, thank you all for listening in. If you have questions, please send them directly to any one of us. Please reach out and touch us. We're anxious to have those conversations to help us with our analysis, and I hope this was a good way of thinking about the management consulting space as we saw it in 2012, what we're seeing in 2013, and what we're anticipating next year.
Great. So I think they always say that payback can be a bitch. So now that Patrick has put me on the spot, this is my favorite part of any webinar, is when you guys get to ask questions of the analysts and put them back on the spot. So if everybody out there who's listening can do me a favor and give Patrick as many difficult questions as you can, please send them through now. We've had a few come through already. The first question we got, guys, is you mentioned APAC growth slowing in 2013 and 2014. Can you explain why you see that happening?
That's a great question, and that gets to, so that question gets to exactly where we how we approach looking at the management consulting space, I think, differently than others. So I'll take it from the two different angles you could come at it. If you've been watching China, and let's be honest, that's going to be the engine of either growth or a deceleration in that region. If you've been watching China for the last 10 or 15 years or however long, you can read every kind of different analysis about where China is going to go. Is it going to grow? Is it going to shrink? Is it growing too fast? Is it going to be a bubble? There's all kinds of analysis out there. You'll never get one consensus view on what's going to happen in China. I think that's important to know, because at TBR we're not going to try and come up with a full understanding of what's going to happen to China. What we're going to do is we're going to try and understand what's happening to these vendors and within their businesses in this region, including China. And so if the Chinese economy slows down, what's the impact going to be on Deloitte and Accenture and McKinsey? And how is that going to impact their business in China? How is it going to impact their business in APAC? Are they going to be able to move resources from a no longer as much needed in China to India, to Kuala Lumpur, to Myanmar, which was on the map earlier? So I think it's important. When we talk about a slowdown in APAC, I don't mean that we're going to try to predict what's going to happen to the Chinese economy. I mean, we're looking at the vendors in APAC, what's happening to them, and what that will mean for the benchmark vendors, but then for the management consulting practice as a whole. So I hope that answers the question.
Okay. I know that we've booked out till the quarter of the hour, so we're running a little long. We have a couple more questions. If we don't get to all of them today, we will reach out directly to those folks that have posed questions. The next question we had come through, guys, is have you considered other vendors in this benchmark, such as Infosys and Wipro?
Yes, and Infosys and Wipro are great examples of companies that have, for a few years now, talked about getting into and made investments in and efforts to get into the management consulting space in a significant way. If you think about management consulting for the full spectrum, or consulting from sort of the McKinsey's doing strategy all the way down to the work Infosys doing offshoring and IT offshoring and BPO and all that. That's the full range, and you've got Infosys and Wipro and others that are trying to move up the ladder. That is difficult to do. They've got to hire the right people. They've got to get the permission to go into the boardroom and present strategy, which permission that McKinsey has and Infosys doesn't necessarily have. Will they be in the benchmark in the future? Possibly. We need to figure out exactly how we would work them in. I suspect if they were, though, they would in some ways look like Capgemini. There would be a small bubble to the far left, where you wouldn't see a lot of growth necessarily, and you certainly wouldn't see a lot of revenue. But that could change. It's a great question. It's something we need to consider, and we'll get back to you on.
Okay. Looks like we have time for one last question. You list some acquisitions, but do you rank them or evaluate impact on each vendor?
No. And we might. It's something we've considered. Acquisitions is tricky because acquisitions are made for a lot of different reasons. They could be for a particular geo, they could be for a particular IP, they could be for just to build out a capability. There's so many different reasons to make an acquisition and so many different ways to evaluate. Are you bringing on revenue, or are you bringing on future revenue? Do you bring people in just to let them go and keep the IP? And there's so many different ways to look at acquisitions. Within this space, we can list all the acquisitions. We're going to be challenged to find a way to rank them, or maybe pick a top 5 that were most significant. We need to do this. This is something we're going to roll out, if not in the next edition of this benchmark, then by this time next year. It's something we have to do, but we don't do it yet. And I would welcome any suggestions on things that we need to consider when we're looking at acquisitions in this space.
Great. Looks like we are out of time, so I want to thank everyone for taking the time to join us today. As I mentioned, I want to give you all the social media links where you can follow not only analysts here, but TBR. and follow them for more insight into what's happening in management consulting, as well as going to SlideShare and YouTube. The URLs are listed here. On your way out today, there's a short survey, 3 questions: how did the presenters do, how was the content, and if there's any open-ended feedback you can give us. We really appreciate it because we are using that feedback to improve our performance quarter to quarter. I'm going to leave the chat function open for another couple of minutes in case anybody has any last-minute questions or wants to set up additional conversations with the analysts. And you should all be looking for the slides that we sent out to you. They will be sent out to you by tomorrow. So if you don't get that by tomorrow, please send me an email and I'll follow up with you. Other than that, we enjoyed our presentation today, and we will talk to you guys all within the next 6 months. Have a great afternoon, everyone.